You get a raise. Not a massive one, not life-changing, just enough to feel like progress. Your paycheck goes up. Your confidence goes up. For a moment, it feels like you're moving forward. A week later, you log into your banking app. There's a notification. Congratulations, you're pre-approved for a higher credit limit. Another one. You qualify for a premium rewards card. Then an email. Based on your income, you may be eligible for a larger mortgage. Interesting. You made more money. And immediately the system responds. Not by helping you build assets, not by encouraging you to invest more, but by offering you more ways to borrow. It feels flattering. It feels like validation. But it's worth asking a simple question. Why does every financial upgrade come attached to more debt? When your income rises, why is the first reaction always an invitation to expand your liabilities? You didn't ask for a higher limit. You didn't apply for a larger loan. You simply earned more. And yet, within days, the offers arrive. More spending power, more leverage, more obligation. That pattern isn't random. It's predictable. Because the moment you start climbing financially, banks don't see a future investor. They see a more qualified borrower. And that distinction matters more than most people realize. Let's take it one step further. Imagine you walk into a bank branch to ask about investing options. You mention you recently got a raise. You say you want to build long-term wealth. The conversation rarely starts with index funds. It rarely starts with low-cost asset allocation. Instead, it drifts toward mortgage affordability, toward how much home you now qualify for, toward monthly payments you can comfortably manage. Notice the language. Not how much you can own, not how much you can accumulate, how much you can service. There's a subtle difference between being wealthy and being creditworthy. Wealth means your assets work for you. Creditworthy means you reliably work to service debt. Banks optimize for the second, and when your income increases, you become more attractive, not as an investor escaping the system, but as a borrower expanding inside it. That's the moment most people never pause to question, because it feels like progress. But sometimes progress in income becomes expansion in obligation. And if you don't recognize that shift early, you can spend an entire decade earning more, while never actually moving closer to freedom. Step back and look at the pattern. Every major financial milestone in your life is quietly paired with a borrowing opportunity. Graduate college, student loans, get your first real job, credit card offers flood your mailbox, salary increases, higher limits, start a family, bigger mortgage pre-approvals. The system does not wait for you to ask. It anticipates your next level of debt before you even consider it. This isn't personal, it's structural. Banks make money on the spread between what they pay for capital and what they charge you to use it. Your savings account might earn 0.5% to 2%. Your credit card might charge 18% to 25%. Auto loans, 6% to 9%. Mortgages, depending on the cycle, even higher. The more stable your income becomes, the lower the perceived risk. The lower the risk, the more capital they are willing to extend to you. From their perspective, this is rational. You have steady employment, you have a payment history, you have predictable cash flow. You are the ideal middle-class customer, not because you are wealthy, but because you are dependable. Dependable borrowers are profitable borrowers, and the middle class, by definition, sits in the most stable income bracket. Not poor enough to default easily, not wealthy enough to be financially independent. That middle position is where lending models thrive. So when your income rises, the system doesn't think, how can we help this person escape debt? It thinks, how much more capacity does this person now have to carry? But it goes deeper than loan offers. Think about how financial products are structured. Rewards cards encourage spending to unlock points. Premium banking tiers require minimum balances or activity levels. Mortgage calculators show you the maximum you can afford, not the minimum you should take. Everything is optimized around capacity. If you can afford a $2,400 monthly payment, the system will show you homes at that level. If your income rises, the number rises with it. Very rarely does anyone inside the system ask a different question. What if you chose to live below your new capacity? Because living below capacity reduces demand for credit. It reduces interest paid. It reduces long-term profitability. The middle class sweet spot is predictable expansion. You earn more, you borrow slightly more, you upgrade slightly more. Your lifestyle grows in proportion to your salary, not explosively, not recklessly, just steadily. That steady expansion is powerful and profitable. If your income increases by $10,000 a year and your fixed expenses increase by $6,000 of that, you feel progress, but structurally, your surplus barely grows. And surplus is what builds independence. When surplus stays small, you stay dependent on income. When you stay dependent on income, you stay bank relevant. The system doesn't need you broke. It needs you stable, employed, and carrying just enough obligation to remain predictable. That's the pattern most people never zoom out far enough to see. Here's the uncomfortable part. Banks do not maximize profit when you become financially free. They maximize profit when you remain financially active inside their system. If you pay off your house early, interest payments shrink. If you avoid carrying credit card balances, high margin revenue disappears. If you build enough assets to live off returns, you borrow less. Financial independence reduces transaction volume, and reduced transaction volume reduces profit. This is not a moral judgment, it's incentive design. A fully independent customer is low drama and low yield. A stable, upwardly mobile, middle-class customer with steady income and manageable debt is ideal. They refinance, they upgrade homes, they finance cars, they rotate credit, they carry balances occasionally. They remain engaged for decades. From a bank's perspective, that is the perfect life cycle. Not broke, not defaulting, not escaping, just progressing within boundaries. That's why the system doesn't aggressively teach you how to eliminate dependency. It teaches you how to manage it. Budget better, improve your credit score, qualify for better rates, upgrade strategically, all good advice. But notice what's missing. There is no structural incentive for a bank to encourage you to minimize borrowing permanently. The middle class is not trapped by force. It is maintained by design. And once you see that, the question changes. The goal is no longer to earn enough to qualify for more. The goal becomes earning enough to need less. Now, let's slow this down. This is not a conspiracy. It's not a secret meeting in a boardroom where someone decides to keep you middle class. It's something much simpler. It's incentives. Banks are not designed to build your independence. They are designed to deploy capital profitably. If you owned a bank, you would do the same. You would lend to people who are stable. You would extend more credit to those with higher income. You would structure products that increase usage. Because that is how financial institutions survive. The system is not personal, it is mathematical, and that's important. Because once you remove the emotion, you can analyze it clearly. Banks do not wake up thinking about limiting your potential. They wake up thinking about risk-adjusted return. A person earning $85,000 with a steady job, moderate debt, and strong credit is low risk. Low risk means scalable lending. Scalable lending means predictable revenue. There is nothing malicious about that. But there is something structural about it. The structure rewards participation. It rewards borrowing responsibly. It rewards staying engaged. It does not reward exiting the cycle entirely. And here's the key distinction. Being middle class is not a failure. It is not a moral weakness. It is not a lack of discipline. It is simply a position within a system optimized for lending. Once you understand that, you stop feeling targeted. You stop feeling victimized. And you start asking better questions. Not, why are they doing this to me? But, how do I position myself differently inside this structure? That shift, from frustration to strategy, is where real leverage begins. To understand how to reposition yourself, you need to understand how the machine earns. Banks do not primarily make money from your savings account. They make money from the movement of money. Every loan is an asset on their balance sheet. Your mortgage, your car loan, your credit card balance. Those are income-generating instruments for them. When you borrow at 7% and they fund at 3%, that 4% spread, multiplied across millions of customers, becomes massive. Now notice something important. The safest borrowers are not the ultra-wealthy. The safest borrowers are stable middle-income earners. Why? Because ultra-wealthy individuals borrow strategically and negotiate aggressively. They have options. They can refinance elsewhere. They can pay off debt instantly if terms change. Lower-income borrowers carry higher default risk, but the middle class sits in the most profitable position. Stable income, predictable employment, long-term borrowing cycles, 30-year mortgages, 5-year auto loans, revolving credit, home equity lines. These are not short transactions. They are multi-decade revenue streams. And here's the key. Most of these products are structured around monthly affordability. The conversation is rarely, how fast can you eliminate this obligation? It is almost always, what payment fits comfortably into your income? Comfort is the keyword, because comfort maximizes duration. If your payment is manageable, you won't refinance urgently. You won't default. You won't panic. You'll simply pay slowly. Over time, slow and steady payments generate enormous total interest. Now combine that with lifestyle growth. If your income rises every few years, your borrowing capacity rises too. Instead of compressing debt timelines, most people expand asset size. Bigger home, newer car, upgraded lifestyle. The system does not force this. It simply presents it as the logical next step. And because humans anchor to what they qualify for, qualification quietly becomes the ceiling of ambition. You stop asking, what do I need? And start asking, what can I afford? That shift, from need to capacity, is where middle-class containment becomes self-reinforcing, not through restriction, but through expansion. Now compare that with how financially independent people behave. The difference is not income alone, it's orientation. Middle-class behavior optimizes for lifestyle stability. Wealth-building behavior optimizes for surplus and asset control. When income rises, the middle-class instinct is to upgrade proportionally, a slightly better home, a slightly newer car, a slightly higher monthly comfort level. The wealthy instinct is different. Income increases are treated as leverage for asset acquisition, not lifestyle expansion. Instead of asking, what can I afford monthly? They ask, what increases my net worth trajectory? Notice the time horizon shift. Middle-class borrowing decisions are anchored to monthly payments. Wealth-focused decisions are anchored to long-term equity accumulation. A house can be a lifestyle upgrade or a strategic asset. A loan can be a liability trap or a leverage tool. The difference lies in duration and intent. Wealth builders compress liabilities. They accelerate payoff schedules. They avoid extending terms just to reduce monthly strain. They prioritize owning assets that generate return over assets that consume income. They also become less predictable borrowers. Fewer revolving balances, lower utilization ratios, less refinancing for lifestyle reasons, more liquidity outside the banking system. From a bank's perspective, that profile is still valuable, but less expandable. Because when someone accumulates enough assets to self-fund opportunities, their reliance on traditional lending shrinks. And reliance is where profit compounds. This is why true financial independence often looks boring. Smaller home than capacity allows, longer ownership cycles for vehicles, higher investment rates than social peers, liquidity buffers that remove urgency. None of these behaviors maximize visible status, but they maximize optionality. Optionality reduces duration. Reduced duration reduces total interest paid. Reduced interest paid reduces lifetime profitability to the lender. And that is the quiet pivot. You don't escape the system by rejecting it. You escape it by shortening your exposure inside it. Instead of expanding every time income expands, you increase your surplus rate. Instead of chasing maximum approval, you target minimum dependency. Instead of asking what you qualify for, you define what aligns with long-term autonomy. That is how positioning changes, not through rebellion, but through disciplined compression. The system doesn't collapse, it doesn't change, and it doesn't need to. Banks will continue to extend credit. They will continue to raise limits. They will continue to calculate what you can afford. That part is constant. What changes is your position inside it. Most people measure financial progress by approval size, higher limits, bigger mortgages, premium tiers. But real progress is measured by decreasing dependency. The moment your surplus grows faster than your lifestyle, the dynamic shifts. You stop optimizing for qualification. You start optimizing for autonomy. You pay down obligations faster than required. You maintain liquidity beyond minimums. You let income increases widen margin instead of expanding commitments. And slowly, something subtle happens. You become less expandable, not invisible, not irrelevant, just less profitable. Fewer revolving balances, shorter loan durations, lower reliance on external capital, higher ownership of appreciating assets. Banks don't push back. They simply have less to extend. Because the most powerful position in a lending system is optionality. When you can walk away from borrowing, you negotiate differently. When you don't need approval, you think differently. When your life isn't structured around monthly obligations, risk feels different. The middle class isn't maintained through force. It's maintained through slow, comfortable expansion. Freedom is built through slow, intentional compression. And that distinction, expansion versus compression, defines the trajectory. Banks don't want you broke. They don't need you wealthy. They want you stable, predictable, and engaged. But you don't have to play that role forever. You don't fight the system. You outgrow the position it assigns you. And once your surplus becomes large enough, the conversation changes. Not because the bank changed, but because you did. If this video changed the way you think, hit like and subscribe. More ideas like this are coming. See you in the next one.